Hi, today we're going to talk about fiscal and monetary policies and functions of money. So, in fiscal policies, government plays a bigger role. So, government uses taxation money and also involved in the spending activity to influence economy aspect. Like government may do more spending to increase the consumption or investment level within a economy, which in turn help the aggregate demand or may distribute wealth between different section of society. For example, like transfer payments may charge taxes in one section of society, may provide subsidy to other section of society to do the welfare. So by doing spending and taxation, government can influence the aggregate demand. So this is called a physical policy where government use spending and taxation techniques to affect the economy. In monetary policy, central bank plays a bigger role. Central bank controls the money supply, and by increasing and decreasing the money supply, it affects the aggregate demand and aggregate supply, which we talked about in previous section. So basically these policy, I would say both physical and monetary policy, they have they are for social welfare. They have some objective, like they want to maximize the employment, they want to move the GDP of nation to the full employment level, they want to stabilize the prices, and also they want to have a moderate long term interest rate, which actually helps the economy, to grow at stable rate. Now we talk about money. So money has a three major functions, like it's a medium of exchange, medium of payment, it's a unit of account. We can say this thing worth this much, so we can account in in terms of money. It's a store of value. So by holding money or by holding assets, or by holding commodities, we can kind of we can we can do an inflation hedge, or so we can buy products, or we can do more consumption, we can do investment. So it's a store of money. We can involve in a transaction and speculative activities by using money. Money can there are two major measures of money. First is narrow money. It basically accounts for notes and coins which are in circulation, plus any highly liquid deposits like your money in checking account or current account. That's called narrow money. Broad money, it's a narrow money plus any other liquid assets which can be used to make purchases, like the money which is in CDs or a money market account, can be included into broad money. In some economy, this money can be categorized into M1, M2, or M3 category. The idea is still the same. M1 is the most liquid, so M3 has assets which are less liquid, or M2 has assets which are less liquid. In a fraction reserve banking system, the basic premises is that when we introduce new money into economy, it increases the monetary supply uh, by much more magnitude, and that magnitude is called a money multiplier. So the idea behind it, if when we introduce a new money into economy, that money will be deposited into bank, and the bank uh, has to have a reserve requirements, so that any demand or for the money can be met from those reserves. So in this case, in this example, if a bank has a deposit of 2500, it can 25% is a reserve here. So out of 2500, that 25%, which will be like somewhere between 600 to 700, they should keep it in the reserve, and the rest of the money they can use for the lending purposes. So in this case, the remaining money will again go back into the economy, and it will exchange hands. When someone deposit the money back into some bank, the bank has to hold the reserve and it can lend the further money. So as you can see, there's a multiplier effect. So by introducing 2500 new money into economy, we kind of created $10,000 of money supply, which we can calculate by dividing it to the reserve requirement. Thank you.